Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we talk to individuals, businesses, and organizations who are taking the lead and whose actions are impacting the well-being of their communities and the world at large.
Welcome back to Money with Mission. Today I have a friend of mine, Dr. Eric Tait. Eric is an investment fund manager with Vernonville Asset Management, a private investment firm that helps investors attain or maintain financial independence using alternative assets. Eric is a physician who is board certified in internal medicine. Under Eric, Vernonville Asset Management has grown to over $100 million in assets internationally and domestically. These include the Hilton Curio Resort in Belize, numerous triple net commercial and light industrial assets, multifamily apartments, student housing, specialty coffee farms, and dozens of single-family homes, private lending funds, and angel investments. Eric is also founder and managing partner of Urban Capital Network, an investment firm that partners with top quartile venture capital firms to allow access to non-traditional venture investors. Eric, you're doing a lot. How you doing?
I am. I'm doing well, Felicia. How are you? It sounds like a lot, but it's really just one thing, helping investors get into non-Wall Street assets. So it's really just one thing. Yeah. Just into different kinds of asset classes.
Spread around. Are you still practicing?
I am. So pre-COVID, I was still 1 day a week. Post-COVID, it's kind of ad hoc. So I go in and see patients as needed. I want them to all get their vaccine before we start trying to bring them back regularly, because I share space with another with a surgeon. And so, we're just trying to keep as many patients out of the office as possible. And being an internist, 95% of what I do is using my brain and looking at labs, and I can do that remote.
So you're mostly practicing remotely. Okay. How long ago did you convert to this 1 time a day for all our doctor friends out there who are still running the
so I did it about 5 years. So when I turned 40, so 5 years ago, I had practiced for 10 years, essentially 4 days a week. And 1 day a week I used to build the investment side of the world. And once I had replaced my physician income on the investment side, I flipped it.
Okay. So now you practiced for only 10 years. Before you started investing right away. First of all, back up. Eric's got an MD and an MBA. So you went to Rice and that's where you got your MBA, correct?
That's correct.
And that was in entrepreneurship, and I forgot the rest.
And healthcare management.
Okay. So how did you think to do that?
So interestingly enough, when I was doing research, so I was an undergraduate, I knew I was going to go to medical school. I had always been entrepreneurially minded. I had businesses when I was in college, and I ended up working at University of Pennsylvania for 2 summers doing research. Okay. Wharton is there. You kind of get a sense of kind of business and healthcare, and so there are a lot of guys from my college who went to Baylor for medical school. So I knew as a sophomore in college that they were setting up the MD MBA program.
Okay.
And I made the calculation that very likely by the time they set it up, I won't need to take the GMAT to get in, and they'll just take my MCAT scores. And that's exactly what happened. So I actually came to Houston to go to Baylor College of Medicine and Rice University to do the dual degree MD MBA program. So that's actually what brought me here from day one. And the reason why I did it was I knew I wanted to practice medicine, but I always had business interests. And I figured having the business degree would cut off some of the learning curve for me to explore those business interests from a time standpoint.
Got it. Because most of us doctor people, at least for me, let's put it for me, had nothing, business didn't even enter my mind. It didn't enter my mind until I started practicing medicine, and I realized how much business medicine was. And then everything just kind of blew up in my face as far as how much business you needed to know. And then I started learning about the real estate investing, all that kind of stuff.
Yep.
Did you start out with, you were looking at different kinds of businesses, or were you always real estate investing were you thinking about it?
No, well, I mean, my first year of medical school, I rented a condo right by the school. I could ride my bike there. And then the person sold it. And I was like, okay, well, it's probably a good idea for me to buy this. So bought the condo, essentially the second year of medical school, but not necessarily because, I'm going to be collecting a bunch of real estate. It was going to be cheaper for me to rent than to buy than to rent. So might as well put something under the belt. In business school, once I learned how to actually do a discounted cash flow analysis, understand that the capital asset pricing model that people use to determine how you build a stock and bond portfolio really didn't make any sense and isn't right. It's right probably 80% of the time, but is not right 100% of the time. I then flipped while I was in business school I always went there to kind of learn business, but then it flipped to how am I going to invest my own money for myself? I was never really planning on going and becoming a medical director in an insurance company or leaving medicine in that way. I was always going to practice. And so for me, it sent me on a quest to figure out kind of where do people become financially independent most quickly? And that is one, and usually in a non-service-based business, and two, it's real estate. All right. And so I kind of figured that out during business school, at the end of medical school and into residency. So then I ended up renting out my condo when I was in residency. That gave me the first taste of passive income essentially as a resident. So I was working as a resident, but then also getting paid, a couple $100 a month with this piece of real estate. And I said, oh, wait, this feels good. I don't know what's going to happen in medicine. I just come out of an MBA with healthcare management, understanding and I just worked the summer before for Aetna US Healthcare, where managed care was started. This was back in 2000. This is 20 plus years ago, right? Mm-hmm. Where managed care was really just starting to really kind of put their imprint on healthcare in a major way. And I said, well, I'm not going to be able to control any of this stuff, because once you get to see behind the curtain as to how the business people view physicians, you realize very quickly physicians have no power. We're just labor, right? And so because we don't control the purse strings, we will never control kind of how healthcare is delivered. And so unless you're going to go cash pay, you're not going to have any control over it. And so for me, having all of my labor income out of my control, that someone else could dictate very quickly how much I was going to make or not make, or how much I had to work or not work, that's really what pushed me towards real estate. Because again, I wanted to practice, but real estate was then going to allow me to replace my earned income probably in the most efficient way.
Yeah. You were obviously a lot further ahead of most of us in that kind of thinking, because knowing the healthcare management side really helped you see that we are factory workers. I mean, we just labor, really. I mean, it took me a long time to see that. It was like, this makes absolutely no sense. I can't control any of it. And then that's when I started doing the real estate investing. So you said, I read one of your things where you were looking for, like you said, something to invest in for yourself, and you couldn't find it. You couldn't find a place to go and do that. And that's what had you and your wife form Vernonville Asset Management. Is that correct?
Yeah, I mean, because, starting out, we didn't know what was going on. And there was no way at that time, there was no way to easily just kind of put your money into real estate projects and get the benefits of being a landlord and owner without the hassle of being an operator. And so I said, okay, cool. I'll just be an operator. Fine. No big deal. Right. And so that's what I did for the first, 7, 8, 9, 10 years, is I just operated our own projects, our own single family stuff, our own multifamily stuff. So I got to understand it from a nitty gritty operational standpoint, right?
Now, hold on. I want to make sure people understand that. Were you doing the air quote management of it, where you were going out or calling somebody to go and fix the toilet, or go out there and cut down the trees, or calling somebody to go and do that? Or
be clear.
Okay.
I evaluated the property online, or called a wholesaler, or I had people sending me deals. I went and walked the property, walked them with the contractor, called the inspector, walked it with the inspector, went through the bids with the inspector, got the bids and quotes from all the contractors, initiated the work, got the draws, got the bank notes, signed on the bank lines, did all of the draws from the banks to do that, did all the lien releases with the banks to do all of those kinds of things. Put the marketing and advertising out there, talk to the tenants, screen the tenants, put their information in, walk the properties with them, put them in, got them out of the properties when it was time to, whether it was eviction or it's time for them to go, all of that. I have done all of that.
Okay. All right. Got it. Okay.
I know how to do all of that.
Which is good. It's just great when you're talking about when you have a passive investor looking to see who they're going to invest with. Eric knows all the parts of the thing. So if heaven forbid somebody quit, Eric's like, okay, fine, I got it. Yep. Not that Eric wants to be out there doing that on a regular basis. No. That is not his best and highest use. But that's exactly what I tell. Sometimes you got to do it.
Yep. And so I tell people the only deals that I probably couldn't step in immediately would be our coffee farms, right? Because I am not Now we have botanists and agronomists and all those people on staff.
Yeah.
But, there would be a little bit of a learning curve there, me figuring that out. But everything else, yeah, I'm not just somebody who aggregates capital or puts people's money together and goes do a deal. Every deal that we do, and now because we do mostly big commercial stuff, which is the easiest thing in the world to manage, honestly. Yeah, I would have done this stuff at the beginning of my career if I had known. Yeah, if my operating partners, something happened to them, I could easily step in without question.
What's your worst investment deal? I mean, everybody always talks about their best and how great everything is, and everything is just great. I know we've known each other for a while, so I know a few of your things. I may not know your worst one. So,
oh, you do. I don't know if I'm going to out them publicly since it's still an ongoing deal. So we'll probably leave that one alone.
Okay.
We're going to leave that one alone for now, but we'll see how much longer we'll keep that stuff quiet. Let's just take a deal that we never had any investors in. Okay.
Okay.
It was a personal care home. For those of you who are unfamiliar with what personal care homes are, those are, think of assisted living, but for people who are either drug addicted or runaways or foster kids or some people who are who are having an issue in their life and need a place to stay with a little bit of supervision. Okay. And so I had a buddy of mine, and he had worked out a deal with someone who was able to get these clients. And so we were buying an apartment complex that had turned itself into a condo. And so we started buying, we were going to buy the whole condominium complex out. And this was in 07, 08. And he had the person who was selling it had cross collateralized it with both other properties that went bad. And so they went and seized this, and he stopped paying on the master lease. So then the mortgage, we then had to take on the insurance of each individual property instead of a master lease. And then that took the monthly mortgage above what we could rent it for, even if it was 2 people in the room. And so the good thing was we didn't have any money in that deal because they were liar loans back then. So we were just able to get it based upon the credit, but we had to give those back to the bank because it just didn't make sense at that point to put good money after bad when there was no way possible to generate enough revenue to cover the monthly expenses on a consistent basis, especially when the person that we charged with keeping the place full wasn't able to keep it full on a consistent basis. And so that really taught me that you need to understand what business you're actually in and understand that hotels and short-term rentals and assisted living and personal care homes and student housing are all hospitality plays that use real estate. They are not real estate investments. Real estate is a major component of it, but it is not a real estate investment. Those are hospitality plays with an operating business in place with staff that you need, that where your staff is going to make you money, not the people just renting for long periods of time.
If you're managing the business in addition to the real estate, if you just have
but even with that, and I'll be honest with you, even with that, even if you own the real estate, the simple fact of the matter is you have to have very good management who's going to keep the occupancy high for you to get your rents.
I gotcha. Yeah, of course. Absolutely.
Yep. Money with Mission is a real estate and business investment company that specializes in finding projects that have the potential to give you a great return on your investment dollar and make an impact in the communities where we invest. Make a difference in your life and the lives of others. Go to moneywithmission.com to learn more.
And then what do you think about do you think the due diligence on the seller was a problem, or do they just have a bad problem?
It was a function of the time. I don't think we'll be in a situation like that again from that standpoint. The other issue is I would never get into a deal like that again, right? I have enough experience to really understand that deal was bad all around.
Yeah.
I was still really, really green back then and was just trying to accumulate assets in an up and coming area, as opposed to really digging into the business. And it wasn't pure speculation because the cash flow was there, but it was speculative enough that, again, you got to know what business you're actually in. Are you in the cash flow business or are you in the speculation business?
Yeah, those can be painful. Those learning experiences are painful. And then you learn and you keep going. Just like Eric just said, you figure out, I got to know what I'm doing here. I got to know what business I'm actually in. And then I can move forward. And Eric didn't quit. Obviously, he kept on going and is now doing very well with what he's doing. He's able to quit his full-time medicine career. You guys are doing some other stuff with angel investing. What's going on there?
So angel and venture. So just to give people a 30-second primer, angel is kind of the earliest stages before there's any revenue. Sometimes it's even before a product is just an idea. Venture is when at least the way we do it is when a lead venture firm, who's all those people do as a venture capital company, is investment every day. So they have an actual company that does nothing but investment. When a lead venture firm has come in and blessed the company and given them an investment, and then we're tagging along usually from that standpoint. So venture is further down the pipe from that. And that's just what that does, is it allows us to get better value out of operating businesses. Okay. I personally stay away from the stock market because you don't know what's going on. You can't control it. And right now pricing is 2 standard deviations above historical norms. So any dollar you're putting in the stock market right now is the most expensive dollar ever put into a stock market in history. Mm-hmm. And so we'd much rather be at an earlier stage of a company before they go public, where we at least understand where the valuations are, and we can make a putative, and the valuations are not about cash flow in that situation. The valuations are about other things. And so once you understand that, and it's hard for real estate investors sometimes to wrap their mind around that, but there is a valuation metric for these early stage companies, especially if they're tech type companies, that will give you a very high level of confidence that the company is going to be worth more in a couple of years than it is today. And so for us, my whole goal with Vernonville is to be the alternative kind of investment platform of choice for busy investors, right? So if you want some real estate, if you want some private debt, you want to get into the early stage investing market, you can do that all under our umbrella, and you get to choose which funds you get in, because you get to choose which projects you get to do. Gotcha.
So it's not an investing. I have so many questions to ask you. It's not just investing into a blind fund and I don't know where my money's going. I've got a guarantee, or air quote guarantee, of some kind of return. You pick which. I want to invest in real estate only with Vernonville. I want to invest in this venture capital. You pick those kind of things. Got it.
Yep, that's how. And so let me break it down. So on the Vernonville side, absolutely. Because even on the angel investing, usually we're just angel investing into one company. On the Urban Capital Network side, that can be semi-blind, because usually we'll have 2 or 3 companies already, and then we'll bring investors in, and with the excess capital, we'll pick 3 or 4 more. Because on the venture side, what you want to do is you have a 90% chance of making 2.7x your money if you get into 24 companies.
On the venture.
That's just the math, period. It doesn't even matter if the companies are good, venture backed or not. If you do 24, you have a 90% chance of getting at least twice your money back over a 3 to 5 year period. And so it's just pure math. And so that one is a semi-blind pool, but it's such a low investment hurdle. It's like 11 grand to get in, right? And so you're able to get in at a lower rate, spread your money across multiple companies, and go forward from that standpoint.
Okay, I want to make sure I was clear on, there's 2 different companies, the angel investor, which is the angel investment company, which is invest in early stage. And then there's.
So Vernonville does real estate, private debt, and some angel investing. So that's all Vernonville. Urban Capital Network is purely kind of the venture stuff. Now, we may get some companies that are a little bit earlier, but most of what we do is venture only. There's no real estate in there or any of those kinds of things.
Okay.
And then that company, I'm partnered with 3 other people, whereas Vernonville is just my wife and I.
Okay. And I'm going to have everybody indulge me for a moment, because I've been trying to figure this out. And I'm one of those real estate investors who has a hard time wrapping my mind around valuing companies for making no money. Mm-hmm. And Eric is really good at explaining stuff. Okay, so help me understand these multi-million, billion-dollar valuations on these companies that are making no money. And it seems to me like they're valued on how much money they've raised. That's how I've been able to understand it, but it makes no sense to me.
Yeah, so we don't go in that late. So we're usually at seed round, which is after the friends and family, or a series A or a series B round. Okay. So most of the time, the companies are not valued at billions of dollars as of yet. So we're still early. Okay. I can't tell you about, Uber being valued in their G round right? Because that's just on the come.
Okay.
But essentially the thing is, and let's just keep it around tech enabled companies. Let's just make it easy from that standpoint. And so, and especially a tech enabled company that has what's called a SaaS model or a software as a service, where you're paying a monthly revenue fee. Okay. So understand that if you use this company's service, you will pay a monthly fee to do it. So there's a revenue stream that comes in, right? So you using it, they're getting paid, right? Now, they may not be profitable, but they're getting paid. So their business model at its core says, if you use my service, I'm getting paid not one time. So remember back in the day, you could buy your Windows and you had the whole suite of Windows,
Right.
and you could use it.
Yeah.
And you could use it for 12 years if you wanted to, if your computer stayed along. Well, companies got wise and said, you know what? We gave up all that revenue every year. We're not doing that anymore. You need to pay us every year for this. So whether it's your Norton antivirus or your Windows, you're paying a software company every year to do it. That is the model.
Okay.
And so now it's just a question of, it's not a matter of profitability, right? It's a matter of what? How many customers do you need to reach profitability?
Okay.
Got it?
Okay.
Remember, software, it only costs a fixed amount to build it.
Right.
So once you get to a level where you can churn out software, which essentially costs pennies to replicate, at some point you'll build up a decent amount of employees. Cool. You're going to build up more employees before the customers, very likely. So
Right.
you're losing money. But at some point there's an X, because when you start making money, the incremental cost to continue to make money is 0.5 cent or 5 cents.
Okay.
Right. But then every year you're giving me $100 and the next customer's giving me $100, the next customer. And so that's why you get this logarithmic or J curve after companies reach that profitability point. And so what you're looking for is velocity of customers being acquired at a cost that is less than the cost to produce the product. So the faster these companies are bringing in customers, right?
Yeah.
That's how your valuation model is going to look. And then what they do is they take a multiple of it. So that goes into it, but they take a multiple of revenue and then multiply that by X amount, right? And that's what it is. And so that's why growth matters more than anything else. But now you got to get into the weeds, because then there's something called unit economics. Unit economics are, well, how much is it costing you to acquire a customer versus how much are you making, right?
Right.
And companies that just throw money down a rat hole of marketing, that was the .com issue. So you saw all these Super Bowl commercials, right? Their cost of a customer was way higher than what their customer would ever pay them over their lifetime.
Okay.
That's all been fixed now. And so most of these companies that you're seeing, at least on the software side, have figured a lot of that out. Now, Uber is not necessarily a software company, because they are dealing with employees. So a lot of these things that you're like, well, these companies are never making any money. They're not pure play tech companies. They've got some other things going on, right?
Yeah,
They've got Tesla is a hardware company, right? So they've got high fixed costs because they're building vehicles, right?
Yeah.
Google is a pure play software company.
Yeah.
Right. I mean, so that's why they make Microsoft pure play software company, right? So, and then based upon how much hardware you're in, your multiple will come down. But ultimately, it's customer growth,
acquisition,
cost of customer acquisition, unit economics, and then how easy is it for you to keep your customer, right? It doesn't matter if you get one and you lose two, right?
Yeah.
So something called churn. So if you're getting a lot of customers and very few are falling off, then you're continuing to build, And so that's the easiest way, without going into super weeds, that hopefully I can explain to you how these companies are valued. Because once they become profitable, once they have one more customer that is needed to create profitability, that next customer on top of that makes them wildly profitable, right? And so you're talking about 70, 80% margins on these companies once they get past what we call kind of the valley of death. Once they're past that valley of death, every incremental customer just increases their profitability, ridiculously.
So thank you very much. That really helped me. That helped me a lot. I hope you guys didn't get lost in all that. I have invested with a group in some venture funds, and I just didn't. I was like, I don't really understand how you guys are valuing these. I trust you guys. That's why I'm investing, but I don't understand how you're getting here. That helped me a lot. So tell me about the kinds of companies that you invest in. This is part of your give back, as far as, your impact, right? You're investing in certain kinds of companies to help people become better.
Yeah, so it kind of goes across all, right? So with Vernonville, our big thing is Main Street, not Wall Street, right? So we want to have the direct access to the tenants and the people that we're working with. So like during COVID, we could work with mom and pop stores and families and give them some break or put their rent on the back end and do those kinds of things, right? Mm-hmm. So our big thing is to be a good steward in our specific individual communities. The other thing is just our investor pool. Because of my social network, I have a high percentage of people of color, of women, specifically single women, who are investing with me. They can't get into 240,000 square foot light industrial projects on the institutional side, right?
Right.
And the same thing on our venture side, right? And so the investors that invest with us, in many ways, are the mission as well, because oftentimes they're coming from communities where there's not a lot of wealth already being created in this way. And then lastly, not so much so on the Urban Capital Network side, there's a dual mission, right? So one is, we keep our minimums low to let people who traditionally have not had access to venture to be able to get in and not let finances be a huge barrier. But the second thing is, and that we're agnostic about the companies we invest in. It doesn't matter. Like we have some companies that are founded by women, some that are founded by people of color. That's not as important to us as making the money because of who we have as our investors coming in. But at our management level, we take a portion of our profits and management fees, and then we invest in companies of color and founded by women at our level. So our investors' money isn't going into that, ours is. And we will do that at an early stage or a seed stage, so at the more risky stage. Now, what we're probably going to do is open that up to, because we have some investors who believe in that mission as well and want access to those same companies. So while that's not our core flagship product, we will likely put a small fund together for people that want to get in and believe in that mission. But we're just letting people know, hey, this is higher on the risk curve. You understand this. And we all think, and we've already invested in these companies. So we already have money in. We just think that they have a good chance of going forward. And for those who believe in the mission, we don't want to take away their ability to get access to it. And so we'll create what we're going to call our elevator fund for those who want to have access to those types of companies as well. But people have to be clear. This is not our core product. This is not our core thing for most of our investors. But if you want to join us, feel free. It's on you. Okay.
So we've talked about something that you have to give to the listeners, and that's a white paper about alternative investments. Is all of this kind of stuff in there about your venture and angel investing, or is there some other way they can find out more about that?
So on the alternative investment, it's just a very high level understanding of what's considered alternative and what's not, and the pros and cons. So not kind of deep into this, because these are kind of weeds types of things. From learning about that, urbancapitalnetwork.com, you can go on there, you can sign up for our newsletter. You'll see a lot of the things that we have there from that standpoint, which is, again, purely kind of on the venture kind side of the world. And then just at Vernonville, that's just kind of on the real estate side and the private debt side of the world as well.
Okay. So to get the alternative investments white paper, go to Vernonville at moneywithmission.com and say again how they find out more about your venture investing.
Oh, so it's urbancapitalnetwork.com. So www.urbancapital with an AL capital, not the DC, network.com.
Perfect. Eric, thank you so much. You helped me a lot. I think you probably helped a lot of people. And I think what you're doing is amazing. I'm really excited. I'm sorry we haven't stayed in touch more. We have to stay in touch more. I'll be getting in touch with you about urbancapitalnetwork.com.
Absolutely.
Thank you.
Absolutely.
That's amazing. Thank you so much. I appreciate it.
No, thank you for having me on. And hopefully this was helpful for your listeners.
I really think it will be. Thanks.
You've been listening to Money with Mission. There are projects happening right now where you can make a great return while positively impacting the lives of others. To learn more about today's guest or to download 7 steps to building resilient wealth for women, visit www.moneywithmission.com.
I hope you enjoyed the interview and are inspired to give your money a mission. Until next time, send your investment dollars into the world to bring you a financial return and improve the lives of others.